All right, well, let's get back to the markets. Obviously, a lot happening here as well today. So we had that banner week last week, and the market still is looking for that next leg up. We're higher now, but not by much. And you know what? It hasn't been swayed as much recently on these Ukraine headlines that we've seen. And again, the markets did not really move during the press conference from President Biden. But there's still plenty of uncertainty for investors to sift through. I want to bring in Slate Stone Wealth's Kenny Polcari and Macro Trends Advisors Mitch Roschelle, and it's great to have you both here, both good friends. Kenny, I'll start with you. The markets it seems that we're kind of stabilizing as far as the headlines coming out of Ukraine, but at the same time, now the attention is shifting back to Fed Chairman Powell.
Right, as it should, right? Because in this country, that's really what we have to focus on now after his latest comments about, rising, putting in a 50 basis point increase in May and potentially another one in June, which was very different from what he said even a week ago when he was happy with the gentle 25 basis point hikes between now and the end of the year. So he continues to create some confusion, and the market's trying to sort it all out, right? What does it mean? What if we go 50? Can we handle it? If we can't handle it, what does that mean? Have we put in the lows or not? And so there's still lots going on, which is why you see yesterday we're down 200 points, today we're up 200 points. We're really marching in the same place as investors and markets try to decipher and stabilize around the trend lines, really.
Yeah, and these interest rate hikes, Mitch, are going to have just ripple effects throughout the economy. We've already seen the 30-year mortgage hit 4.5%. Most analysts didn't think that was going to happen until the end of 2022. That's one side of the story. But also this economic data we got today, Mitch, with the labor market. I mean, we had numbers on initial claims we haven't seen, and continuing claims in particular, we hadn't seen since 1969. I mean, we've got this tight labor market. So great, people have jobs, Mitch, but the labor market is still incredibly crunched. And then durable goods, also a down number there, more than expected.
Yeah, I'll take those, Cheryl, in reverse order. I think the durable goods story, and obviously autos and airplanes are the more volatile pieces of it, but I think it really is a telltale sign, especially if you focus on autos. People aren't buying durable goods because they can't get them. The delivery date for a new car is a year out. The delivery date for a refrigerator is 9 months or so out. So I think the consumer and businesses alike are starting to get very, very frustrated with their inability to buy those durable goods. And I think we're going to see a continued decline there. And those are big ticket items that are important to the economy. On the first point, the labor market is incredibly disrupted in a way that I don't think we've ever seen before, where we have, millions more open jobs than we have unemployed. That's going to continue to drive up wages, no doubt, and it's going to be a vicious cycle of inflation. Going back to the point Kenny talked about, which is what the Fed does. I think inflation's here. This is not transitory. This is going to continue to be a problem, and I don't know what tools they have to address this labor market disruption.
Well, no, I mean, that's what the tools that they seem to have in their toolbox, if you will, is going to be maybe 50 basis points in May, 50 basis points in June. Kenny, also, I got to go back to the issue of energy. I was talking to Christian Whiten and Edward Lawrence about this, these announcements, Russian energy and the oil markets and what it's done to the markets overall. But there are ways investors can play this, and I know that you're doing that.
Well, listen, I've been looking at energy. I own energy. I own it a couple of ways. I own it in the ETF. I also own individual names, right? Exxon and Chevron have been always two of my favorites for a number of reasons. They're big, they're mega cap US, they're good dividend payers, but they're going to benefit directly, and they have benefited directly from what's happened in energy. But look, and I think the senator that was on with Neil was talking about our ability, US's ability, to try to stabilize and correct this energy problem. It's just whether or not the administration wants to really correct the energy problem in terms of, having us become the swing producer the way we were under the prior administration.
Yeah. Mitch, final thoughts?
Yeah, I think that the bigger story to keep an eye on is how the European economy is doing. There was better than expected data coming out of Europe, but I think the mess in the Russia-Ukraine area is going to have its first order effect on the economy in Europe. And we can't forget that our economy is linked to others. And I think we have to pay very close attention to maybe the economic indicators from Europe first before we start looking at our own.
Right. And, emerging markets has been something that a lot of people have been talking about as a play because of what's happening in the U.S. with inflation and I mean, people are mentioning recession, the possibility of recession in the second half of the year. I hope that's wrong.
Listen, Cheryl, I'm going to say one thing that I don't think anyone's talking about yet, that they're going to realize with these rising rates is going to be revolving credit card rates are going to go up, and home equity loans that are tied to floating rates are going to start to go up. And, and that's going to put more pressure on the consumer and more strain on the system.
Yep. And I think housing values and sales are going to go down. And we're already seeing that. And Mitch already knows that. So I'm not even going to let him talk again. Kenny and Mitch, guys, it's great to see you both of you guys. Thank you so much.